I'm the money guru. I can help you with your bank account. I'm gonna teach you everything about finances. So let me drop some knowledge, listen close and learn. A final message from the guru, watch your money grow and burn.
So if you like what you see, hit that subscribe button to join our community.
Yo, pull up quick, let me drop a fact you didn't know. 9 out of $10 you put in your bank account is not even sitting there as cash in the vault.
No, it's already been loaned out the second that you sign the deposit slip. The whole system's built on trust and promises. But is your money safe, or are you gonna lose your whole savings account? That is the real question we're seeking to find out. Today, we're getting past the scary headlines and the financial media's noise, and we'll break down the secret system with all its joys. We're gonna cover insurance, those famous bailouts, and then the difference between the two, so your money feels brand new.
Cause bank failures happen, and they will happen again. But knowing this system is like having the map of a hidden land.
You think you know your bank account's safety, but I promise you there are layers deep beneath the surface that are worth exploring right now.
Is it the FDIC? Is it the government? Is it magic? We'll see how your cash is covered to the very last dollar. Stay tuned. It's time to learn the system's whole design and truly understand the truth about financial crisis and why banks survive this plan. So what are we really talking about when we say bank safety in simple terms? It's all about deposit insurance, the protection firm.
Deposit insurance is a safety net from the government, which guarantees your savings up to a limit in case your bank gets crushed.
It means that even if the whole bank goes completely broke, you still get your cash back. It's not some kind of joke. Think of the FDIC in the US or similar groups worldwide. They were created because bank runs were a problem we couldn't hide. Back in the Great Depression, people lost everything in their savings when banks closed doors. Now that fear won't visit our shores.
It exists to make sure your deposits are safe and to stabilize the entire financial market and system. This is its design.
If you trust the bank, you leave your money where it's at, and the whole economy keeps spinning, and that is a fact.
It works for checking, savings, and even certificates of deposit, but it does not cover risky stuff like stocks or bond pits. So it's not some kind of magic fund that the bank keeps on the side. It's a huge collective safety pledge where funds do reside. It guarantees that your primary life savings will never just disappear. Now let's use an analogy to make the picture crystal clear.
Okay, forget the big bang structure, let's make structure last. Savings is not money, but a massive slice of pizza that will last.
Everyone in the neighborhood puts their money together and buys one huge pie. This giant pizza is now the shared fund, don't ask why. Now, the bank is the pizza manager, running this whole operation. Their job is to keep the slices safe for every single population. But here is the trick. Most people aren't hungry at the same time, they only need a tiny slice for a little bit of time. So the manager takes the extra slices that no one is demanding right now and loans them out to neighbors, making profits somehow.
When they pay it back, they give a little extra cheese for the loan they took. That's how the bank makes its interest profit. Check out the book. So, the bank is running on the assumption that only 1 in 10 people will want their entire whole savings slice at any one time.
But what happens when everyone suddenly panics and needs their entire whole slice back from the fund? That's when the system gets stung.
That rush is what they call a bank run, and it caused the failure. That's why we need an outside guarantee from a total safe sailor.
The deposit insurance is the guarantee that your portion of the shared pizza fund will be replaced. It can't be misplaced.
It's not about the manager's cash, it's about the insurance fund. Now let's dive into the actual steps and see where the money is bound.
It's a safety mechanism designed to stop the entire whole system from seizing. Let's get into the step-by-step detail that is now pleasing. So, how does this safety system actually kick into action, step by step, when a bank runs out of cash, losing all of its traction? Step 1. Remember, your money isn't just sitting in a vault where it waits. The bank takes your dollars and uses them to loan out all through the gates. Step 2. The failure starts when too many folks rush to withdraw their whole cash total. Suddenly, the bank can't cover all of their debts. That's crucial.
The bank runs out of the liquidity, the ready cash they had, and they must close down the window, making depositors mad.
Step 3. That's when the deposit insurance team, like the FDIC, they step in. They quickly seize the assets and the records to begin.
They are the receivers, they're not there to try and make a profit. They just want to make sure that your covered cash is not lost. Stop it. They check the account total, they see how much you had covered. They use the insurance fund to replace the money that was hovered.
Step 4. You get your cash back. often within just a few days of the shutdown. You don't have to wait years for the bank to settle down. The insurance fund works fast because they want to prevent a massive spreading of the fear. They stop panic and keep the whole system crystal clear.
This process is automated, smooth, and designed to protect the average person's savings, making sure their money is not lost to cravings.
The key detail is this: the funds come from the insurance fund, not the bank's own empty vault, and it's a planned fault. That fund is financed by all of the banks that are healthy and working fine. They pay premiums to keep this giant, crucial safety line. It's insurance for the banks themselves, protecting the system's design. Now let's see this in a real-world scenario. I think it's time.
We'll look at the crisis in 2008 and how the typical family was shielded. We need to see the numbers to know how this system yielded. The insurance mechanism worked then, preventing widespread panic that was bound. Your money is protected, it's not a risk on the ground.
Now keep this $250,000 number in your brain because it's the magical limit. It's the final, crucial refrain.
Let's jump in the time machine back to 2008, when the financial system was on the verge of total collapse, sealed with a fate.
When giants like Lehman Brothers completely went belly up and vanished, panic spread quickly, making everyone truly astonished. But here's what the headlines missed. For the average person with savings, they were largely protected because of the FDIC's cravings. The limit back then was $100,000, but Congress quickly pushed it higher, up to $250,000, setting the entire savings on fire. Imagine a family, Alice and Bob. They had $150,000 saved for retirement. Because their total was under that magical cap, the deposit insurance stepped right up and delivered their full money back, avoiding a trap. This is the crucial difference. The stock market crash and the bank failure are separate scenes. This insurance keeps your savings on its means. It's a huge promise of trust that the government makes with the people, ensuring that the working class won't suddenly be made unsteeple. Now, if Alice and Bob had $300,000 saved in a single deposit, they would only get $250,000 back. That's their final limit.
The remaining $50,000 would be unsecured, or so that bank's slow liquidation. This is why you gotta diversify and use multiple banks, or look into different ownerships to avoid all the final ranks. So, for the vast majority of citizens and their cash savings, the deposit insurance is a solid shield that stops all your cravings. You hear these terms on the news, making everything sound completely intense. Let's break down the truth of a bailout and stop the expense.
A bailout is when the government steps in with the taxpayers' money, giving huge amounts of cash to a failing financial entity. That's not funny. It's used for institutions that are considered too big to completely fail. This is to stop a global economy problem or a worldwide financial gale.
Now, a bail-in is something totally different in its whole design. The bank's own bondholders or shareholders take a hit down the line.
It means the investors who bought the riskier debts are forced to cover the loss. The common taxpayer doesn't have to carry the heavy cross.
It shifts the burden of bank failure to those who invested their cash because they were seeking bigger profits in the final cash splash.
Now listen closely, this is the most important part you gotta know. Your insured bank deposit is completely safe and won't go.
The bail-in mechanism is aimed at riskier assets, not your savings account. Deposit insurance is a separate safety system we must account.
So, you're checking.
These two financial methods often get confused.
So, next time the news reports a massive bank is collapsing on the ground, remember your insured cash is completely safe and won't be unbound. It's protection for the people and not for the massive, huge institutions' mistakes. Now you know the facts behind the crucial money breaks. Alright, we broke down the whole process, starting from the basic deposit. We sliced the truth from the fear, and that is the final profit.
Remember, your core savings are protected by a giant financial shield, ensuring that fear doesn't spread across the entire whole field.
The limit is key, $250,000 per depositor per bank, so split your huge pile up if you have too much in the final rank.
And remember the crucial distinction. Deposit insurance is not the same as a bail-in. Your stocks and bonds aren't covered, so don't you grin. Understanding this system allows you to manage your funds with zero fear of the failure. Now you're equipped with knowledge, so go be a life sailor. Hit the like button, subscribe, and share this information with your crew so everyone can manage money knowing exactly what is true. Next time, we'll dive deep into different types of ownership that you can use to boost your insured limits without having to lose.
The money maze is complex, but the truth is plain to be found. Knowledge is power, so stick with the guru to completely surround.
Check out this video right here for the next level of knowledge on how money flows. And make sure to leave a comment down below. Tap the logo on the left to subscribe to 3i/Atlas and stay completely in the know. We simplify the complex concepts in a seamless flow. Thank you for watching and supporting the channel's important mission. Until the next video, keep learning and trust your tuition.
This is the Money Guru, signing off and making sure that you get the full scope. Remember, stay informed and maintain your hope.